Hey everyone, today we're jumping headfirst into the pretty wild world of financial markets. We're going to break down some seriously powerful and kind of complex financial tools, all guided by Colin Bennett's amazing book, Trading Volatility. So let's kick things off with a question that honestly sounds like it's straight out of a sci-fi movie. Can you actually trade a storm before it even forms? Is it possible to place a bet on market chaos that you feel is coming but just hasn't hit yet? Well, believe it or not, the answer is a resounding yes. And we're about to figure out exactly how. All right, here's our game plan. First, we'll look at the basic tools for betting on those future market swings. Then, we got to talk about the famous fear index, which is how we measure all this stuff. After that, we'll dive into the main marketplace where these trades actually happen. And for the grand finale, we're going to go one level deeper into something I like to call volception. Okay, first things first. To trade something that technically doesn't exist yet, you can't just go out and buy a stock. Nope, you need a very specific kind of tool, a contract that lets you lock in a price today for a trade that might only start weeks or even months from now. And this is it, our fundamental building block, the forward starting product. The easiest way to think about this is like pre-ordering an insurance policy for your stocks. You pay a little bit today for coverage that only kicks in, let's say, 3 months down the line, protecting you from that storm you see brewing on the horizon. Now, this is where it gets really, really interesting, because pricing this thing isn't simple at all. You're not just trying to predict future market craziness, you're trying to predict what everybody else is going to think that craziness will be at that future date. It's literally a forecast of a forecast, and that is a serious puzzle to solve. And to solve that puzzle, traders went through a few different ideas. The earliest models were just way too simple. They kind of assumed the shape of volatility would just stay the same, which, spoiler alert, it almost never does. Then they tried some more math-heavy approaches, but those had their own problems and would often fall apart when the market got really wild. Finally, the industry landed on a much smarter model that does a better job of handling how market sentiment actually shifts and changes over time. So the big takeaway here is that getting the price right isn't just about guessing how high volatility will be. No, it's about predicting its shape, what traders call the volatility smile. Think about it like this. Are investors more scared of a big crash than they are excited for a huge rally? Usually, yeah. And that imbalance creates this sort of smirk or a smile in the data. The constant smile rule is just the industry's best shot at predicting the shape of that future smile. Okay, let's move on to the next piece of this puzzle. See, if you want to trade volatility, you first have to find a way to measure it in real time. You have to take this abstract concept of market fear and somehow turn it into a solid, tradable number. And that, right there, is where the famous VIX index comes into play. You've probably heard it called the fear index on the news, right? It's not just some catchy name. It is a live number, calculated from thousands of S&P 500 option prices, that gives us a real-time snapshot of the market's expected choppiness over the next 30 days. Now this chart, this shows something really fundamental about the VIX. That top line is the VIX. It's what investors expect volatility to be. The bottom line is what volatility has actually been. And notice something? The VIX line is always higher. That gap between them, that's the risk premium. It's basically the extra price investors are always willing to pay for insurance against a sudden market crash. Okay, so we have an index that literally measures fear. What's the logical next step for Wall Street when they have a number they can track? You guessed it. They create a marketplace to trade that number directly. And enter VIX futures. These are pretty straightforward contracts that let you bet on where the VIX index will be on a certain date in the future. You think fear is going up? You buy. You think things are calming down? You sell. They have become by far the most popular way to trade volatility, way bigger than those complex options we talked about earlier. But this whole thing wasn't an overnight success story. The first try, way back in 1998 in Europe, kind of just fizzled out. It wasn't until the Chicago Board Options Exchange launched VIX futures in 2004 that it really started to get some traction. And it absolutely took off after the 2008 financial crisis. The trading volume just exploded, and it became a totally viable tool for investors all over the world. So here's the basic trade-off. Those custom-built options we started with, they're like a surgeon's scalpel. They give you incredible precision, but man, they can be expensive, and sometimes it's hard to even find someone to trade with. VIX futures, on the other hand, they're more like a Swiss Army knife. Totally standardized, super easy to trade, and pretty much accessible to everyone. But what if we go even deeper down the rabbit hole? What if your bet isn't just about whether the fear index goes up or down, but on how volatile the fear index itself is going to be? Well, welcome to Volception, trading the volatility of volatility. That's right. The market actually created options on the VIX itself. These things let you bet on just how much the fear index is going to bounce around. It's a bet on the size of the market's mood swings, and this leads to some really strange and counterintuitive behavior. For instance, just take a look at this. The gray line shows what the market thinks the VIX's volatility is going to be. The red line, that shows what it actually has been over time. You see how the market is consistently pricing the future volatility of fear lower than what's actually happened in the past? It's like traders are always betting that things are about to get calmer, which is just plain weird. So this leads to a massive question, right? Why on earth would the market constantly underprice the risk of a huge volatility spike? Why are traders always betting on calm? The answer, it turns out, is in the fundamental nature of volatility itself. And this chart shows us exactly why. See, unlike a stock price, which can just crash and burn, volatility has a floor. It literally can't go below zero, but it has no ceiling. In a crisis, it can spike to unimaginable highs. And as you can see from the shape of this probability curve, there's a long tail stretching out to the right. That just means there's a much higher chance of a massive, explosive move up than there is of a complete collapse to zero. So let's wrap this all up. What are the key things to remember? We started with these special tools to bet on future volatility. We learned how the VIX, the fear index, is the key benchmark for measuring all of it. Then we saw how VIX futures created this enormous marketplace to trade it. And finally, we saw how you can even trade the volatility of the VIX itself. We've literally learned how to measure, package, and trade the concept of fear. Which leaves us with one last kind of provocative question to think about. We've built this incredible, complex financial machine to predict and trade the future. But by creating a multi-billion-dollar market that is focused entirely on betting on fear, are we actually influencing the very future we're trying to forecast? Does trading fear just create more fear? It's definitely something to chew on.